Many of you have heard, and many of you have even memorized the poem Invictus by Henley. When I was going to school here, I remember it made that big of an influence on me that I memorized it. So you guys all know it. Out of the night that covers me, black as the pit from pole to pole, I thank whatever gods may be for my unconquerable soul. You know, and the last one, and that is not how straight the gate, how charged with punishments the scroll. I'm the master of my fate. I'm the captain of my soul. I remember using this to kind of help me and give me incentive when things got tough and when things were a problem that I could think about this. And then I remember reading this from Orson F. Whitney. And I understand what Henley was trying to do, and I applaud him for it. But I like the soul's captain by that. Art thou in truth? Then what of him who bought thee with his blood, who plunged into devouring seas and snatched thee from the flood, who bore for all our fallen race that none but him could bear, that God who died that man may live and endless glory share? To what avail thy bonded strength apart from his vast might? Pray that his light may pierce the doom, that thou mayst see us aright. I'll let you read the last three verses. But I think it's important, especially in this class, we talk about ownership. None of it's ours. We're stewards. Do you ever think that we're stewards over our intellect? We're stewards over the things we learned. We're stewards over all of these things. In times of contemplation, I've thought, you know what? Not even our bodies are ours. We are the genes from our parents. You know, things like that. So as the more we think and the deeper we think, the more we are thankful to a loving Father in heaven and his Son for all the things that we've done. Okay. We had a good group yesterday. We just kind of finished out the home buying process. Hopefully you guys feel that you could actually go understand the process of buying a home, understand the process of finding funding, and getting the best loan, particularly at effective interest rate. How was the quiz? Are you getting a little bit more comfortable with the tools? There are some fun tools there. Okay. Let's start. So we're starting the section on insurance. So here's what's required on the insurance section. Number one, you're going to have 5 different sections: life insurance, health insurance, disability, auto, and homeowners/renters insurance. So you're going to have 5 different areas. There's the template. Question is, do you need it? And you're going to answer for each of those 5 areas. Do you have it? How much should you have? What type is it? What are the costs and coverage? What are the discounts / specifics? I'd like you to include a copy of your clue report. Anyone have a clue report? Anyone know what a clue report is? Pardon me?
No.
Okay. It's comprehensive. It's a comprehensive liability underwriters exchange. So we don't have a clue report. So each of you will have to check and see if you have that. If you have any insurance that the insurance company's paid off, that they paid off an accident, either from you or you were in an accident, that will be on that clue reports. So we'll actually have you pull that. There's a Learning Tool 29, life insurance needs. There's like a dozen different ways to calculate your life insurance needs. And so what we've done is we put kind of 6 of the main ones together. And so everyone's going to have to fill that and figure out what your life insurance needs are. And then your action plan. So you're answering these questions for each of those 5 sections. Then your action plan is, what insurance and coverages should you have? So that's kind of the important thing. So what should we have here? Okay. Risk, good or bad? It depends. What are the things we can do with risk? There's actually only 4 things we can do with it. So you can transfer it to an insurance, some of that risk to an insurance company. Can you transfer all risks? No, I can transfer the monetary risk should I die. But hopefully I can't transfer this weekend we had the 2 grandkids coming over. And now I realize why parents are young when they have kids. But hopefully, maybe the monetary risk if I pass away. But you can't transfer the fund I might have with my kids and things like that. So what else can we do? So we can transfer it. We can assume it. When I got back from my mission, my brother was at a place called Utah Technical College. It's the precursor of UVU. And the instructor, he was in an auto body class, and so the instructor, what he'd do is he'd buy these junk cars, have his students fix it up, and then they'd sell them. He said, I don't want to do that. So he bought a junk car, 1973 Pinto, unsafe at any speed. So that's what I had. And so instead of buying full coverage insurance, the vehicle wasn't worth very much, I assumed that risk. So we've got transfer. We've got assume. What else could you do with risk? Yeah. You can ignore it. That's basically you're assuming that risk. Yeah. How about can you reduce it? I had a Mustang convertible. I put a roll bar on it. How about anyone here have fire extinguishers in your cars? I have fire extinguishers in our cars and in my garage and places like that, so we can reduce it. Or the last one you can do is you can avoid it. You don't skydive. You don't different things like this. So lots of things we can do with risk. And the key really is to understand what to do. So you can divide risk into things. How severe is it? How frequency? How often does it happen? And you could also add a cost thing there. So what do you do with high severity? Well, someone define a high severity, low frequency event. Death. Okay. You die. You only die once, hopefully. What's they say? A coward dies 100 times. So what do you do in cases like that? What would you do? What would you do as far as that risk? What do we do? Would we transfer it? How about a high severity, high frequency? I'm not even sure I have an idea what a high severity, high frequency event is. How about a low severity, high frequency event? I just caught a cold. What would you do on some of those? Yeah, so you can assume. You could also try to avoid. I'm sorry, wrong one. Pardon me?
No, I said that was funny.
Okay. How about low severity, low frequency? Yeah, probably assume/avoid. But the point here is, can you transfer every risk? And the answer is no. So what should be our principles of insurance that should actually take us through each of the 5 different types of insurance? What should our principles be? Again, the first one is easy. Know yourself, your goals. Understanding insurance, is this easy? Are insurance products easy to understand? No. I actually had someone who was extremely high up in the insurance industry. He said insurance companies, I'm not sure, this was just his opinion, purposefully make insurance products difficult so you'll have to trust the insurance salesman to understand the product. That doesn't sit well with me because we need to understand. So what are those principles? So number 1, know yourself. Goals. Because everything relates to what our goals are. Other principles. Yeah.
Gain a better understanding.
Yeah, understand. Understand the products. Realize many of these products, especially cash value insurance, are extremely expensive, a huge amount of upfront fees, And to change these, to start it now and change it in 2 years, I saw an article in the Wall Street Journal that estimated that consumers lose $5 billion a year of buying an insurance product and later changing it. So it's really critical before you make any of these decisions, you make sure that that is what you want. You make sure you understand the products, the benefits, the costs, the fees. You also need to make sure you understand some of these products are based on assumptions and some are based on guarantees. In addition, some of these products will give you your, especially some of the cash value products, they'll give you, okay, here's your estimated costs. These are the costs now, but we can change it later on at the insurance company's discretion and charge more money if we're not making enough profit. So understand the products. What do we insure against? I insure against high severity items. We don't want to insure against the low stuff. Okay, I can breathe easier now. Tyler's here. I was beginning to wonder. So we're insure only against high severity, high cost, high severity losses. The fourth one, high quality individuals and institutions. So that's why I had Tyler come today. He's one of my high quality people. And then the last one, review annually. And make your changes as needed. It's fun. My brother is my insurance agent. So we just have it's just a good excuse for us to get together once a year and just sit and talk. That's mainly what we do. We just sit and talk. But it's nice. But again, if we'll follow those principles, we will do so much better. Let me just do a couple of cautions, and then I'm going to turn it over to Tyler. Here's just number one. Oops. This is just an idea. Someone said, insurance is never your best investment, and investment is never your best insurance. What do you think? Tell me a little bit about investments. What's its purpose? Kind of grow. What's the fee structure? If you do no load, you can actually make the fee structure very small. The purpose is to kind of grow assets so you have the resources you need at retirement. How about insurance? Is it meant to be a low fee structure product? Actually, no, it's a very detailed, it's a very complex product. And so what does that mean for the costs and the fees? Very high. But is there a place for insurance in your portfolio? The answer is yes. And so the key is to understand. So here's just a thought. When you're first starting off, basically what's the purpose of insurance? In case something happens to you. I have a cousin. She was 26 and her husband died. I don't know how much life insurance he had, but I'm sure that it was an interesting experience. So just be aware. Cash value life insurance, it has the place, but it's for 99.5% of the students, it's not. So just be very wise. When I came here, I was very concerned because I found students who didn't know what they were selling to students who didn't know what they were buying, and they were selling cash value insurance. In fact, the guy in charge of operations for all the Western United States, he called me up and he told me, he called me up and he says, well, I'm such and such a person, I work with this company. And I said, you don't have a very good reputation here at the school. And he goes, well, why not? And I told him, you've got students who don't know what they're selling to students who don't know what they're buying. Well, let me come and talk to you. And I said, sure, I would be happy to. About 3 hours later, he was in my office. And this was 15 years ago. So the wonderful thing is I haven't had I haven't noticed that problem. But he started using his flip charts, and I was a missionary with flip charts too. And the first flip chart he showed me was, well, look at if things work out, you can get this kind of return. And he had a slide, an illustration of a 14% return. And I said, that's unconscionable. Who makes a 14% return? Because these are just illustrations. And he put his second slide. And I found something on that slide that in about 3 minutes later, he was out the door. He just did not like me at all. But the point here is we need to understand the products. You need to be comfortable with your insurance guy. I mean, Tyler, we sit and talk and we banter ideas back and forth because, you know what, he's doing what's best for me. And he's concerned, he's not worried about whether he makes his next buck. He's actually worried about that you guys are learning the things that you should. And sometimes I probably teach incorrect doctrine here on insurance products. So he's here to keep me straight too. But it's really important that we understand this area. Go ahead, Andres.
I have a question to that. So, are you also kind of talking about how some people will sell insurance as an investment opportunity?
Yeah, and I would
show you the idea of hey, you get these huge returns.
Yeah.
And it's safer.
Yeah, and so what happens is you hear it on the radio all the time: safe money or green money or things. What they don't tell you is number one is, in fact, I just had a case study called "Insurance versus Investing." It was just published this year, and what people don't realize is, with these cash value products, this is the cost of insurance product now. But if we're not making enough money, there's actually a max cost there too that we can charge. And then also, if these products were so good, how come we don't have a lot more information? Our investments, there's a lot of transparency. But how transparent are these insurance products that you can get out there too? And they're just very not transparent at all. And the other thing too is realize with an equity investment, you know what you're getting. You don't know what the final result will be, but the rules won't change. With many of these cash value products, they're based on assumptions, and those assumptions can change. And so the company can come back and say, we're not making enough product, we'll take the maximum charges. Index universal life, okay, you've got a 12% cap, but we're not making enough money, so we're going to drop the cap to 8%. And so it's an interesting thing, and you need to understand it. Be careful of the things that you see out there written. I've got a book here from someone who's a good friend of mine, and he just leaves out so many different things, and it's almost deceptive. So you have to be careful here. So be very, very careful here. And then just a couple of cautions before I turn it over. I had a good friend. She came in and she told me, she said, you know what, you really should let people know. If your life insurance is from your company, what happens if you get sick and you lose your job? So this happened to her mom. She had life insurance through her company. Her mom got sick, lost her job, and then lost the life insurance. So I recommend that, it doesn't have to be all of it, but just some of it outside that. And then the second one too is just realize insurance is a good product. There's a place for it. It's particularly cash value life insurance. But it's generally not for students, and it's generally for different businesses and things like that. So it's critical that you understand what the product does, that you understand the differences, understand why you're buying before you purchase the product, the policy. And again, that statistic from the Wall Street Journal, $5 billion is lost each year from people who buy a product and then a year or two later decide they don't need it. So it's really important that we go back to those principles. Understand the products. Understand what you want, what are you trying to accomplish with it, and then work with high-quality individuals and institutions. And because of that, I brought Tyler. Tyler been through this program. Normally he brings his personal financial plan because he's been, but I've known Tyler since he was a student here. Were you married when you took this class? And now how many kids do you have? Three. So I'm going to pass the mic over to Tyler. So let's just stick it under it right there. Okay. Just under there, around that. Or you can just whatever you want to do.
Let's do that.
Okay. So with most things, when there's concerns, what I do is I bring in the experts. So how long have you been doing this? Like 10 years?
Yeah, it's been a while.
It's been a while.
Long time.
So after this, Tyler and I went to sit and talk to, so we find out what's happening to his kids and all the new insurance things. We get to spend time. Tyler's a BYU graduate. He works for a large company. We won't say what the company is. He's been wonderfully kind to come and to work with us. Can we have a big hi for Tyler?
Thanks, Brian.
So here's the water for you too.
Thanks. Yeah, you mentioned my folder. I still have it, and I bring it often, but I neglected it this morning. So, wanted to. We go until 15 after the hour. Is that right?
So if you can stop at like
10.
12 after we just do the
Okay.
takeaways for the last few minutes.
Sounds good. Want to just talk today about how life insurance fits into the entire financial plan. And then we'll dig into some of the details about life insurance and some of the different types and different questions that you guys have. I'd like to take as many questions as you guys have. We may get through all the material, we may not, just depending on how the discussion goes. I think it's more important to make sure your questions are answered,
And I'll
than
make sure it's linked.
getting through. Great. So, any questions you guys have starting off? Okay. So if you do, and if I don't see your hand, just yell at me. Just say, "Hey, Tyler," and we'll go through things. So the objectives today are really to understand, as I mentioned, how life insurance fits within the framework. We can talk about what church leaders have said about life insurance as well. We'll talk about the demographics of needing or wanting life insurance, talk about how life insurance companies work, how much coverage is needed or wanted, some of the different types, and then what type is most suitable for you and some different considerations to buying. And so financial security, as we talk about that, help me understand what your thoughts are. When I say financial security, what does that mean to you? Yeah.
To me, it means that you're kind of prepared for what's to come.
Okay.
So you can feel comfortable where you're at, and you won't be just constantly stressing about the future.
Okay. So having some preparation is key in there, and not worrying too much about the near future. Okay. Other thoughts? Yeah.
I like to think that it's protection not only for the down times, but also for the up times, the availability to take advantage of investments or other financially accessible products that would benefit my family and my portfolio.
Okay. So being able to take advantage of opportunities that may arise coming up. Okay. Other thoughts? So you guys are all math geeks, I know, because you're in the Tanner building, right? So I like numbers and I like equations. So I'm going to, I guess you put financial security in an equation here. And so when our assets plus our income is greater than our expenses, then we have financial security. And that equation, how much each of these variables is weighted, depends on kind of where you are in your life stage. So right now, most of you probably have fairly few assets, but your income potential is huge, right? It's a great thing that's going to drive building the assets and being able to cover the expenses. We fast forward to maybe parents or grandparents situation where perhaps their income potential at this point is very low, but their assets that they've built up are quite high, and the assets are going to drive covering their expenses throughout the rest of their retired lives. And so these pieces change as time goes on, and today we're going to focus a little bit on this income piece and making sure that this income's protected. So there's really three primary reasons why income would stop. Can you guys think of a couple of those? Loss of job, okay. Disability and death. That's it, right? Outside of those three things, you can generate earned income. So from a loss of job standpoint, you guys are here, you're spending a lot of time, you're spending a lot of money, you're spending a lot of energy focusing on making sure that you are putting yourself in a place where you can be employable or have the skills necessary to generate that income, right? And the ones that we don't have as much control about are death or disability. And so what do we call job loss later on in life? Retirement, right? I mean, it's the same thing, right? So that's really going to be it. That's going to stop our income from coming in. So that's where we're going to talk a bit about this first piece right here, which is in the event of a death, how do we protect the income so that our expenses can be taken care of? Now, what expenses do you have after you're dead? Funeral costs, potentially taxes. Leave behind a family, okay, that may be relying on you for support and financial means, okay? So these are some different reasons where even though we're gone, we still have obligations or responsibilities that we want to make sure are taken care of for others, so they don't have to deal with those things. So I'm going to jump back to this. Can I have someone go ahead and read this for us? Nice and loud, yeah.
Morning, right?
Yeah.
Okay, so wise financial counselors teach that there are 4 different elements to any good budget. Provision should be made first for basic operating needs such as food, clothing, etc. Second, for home equity. Third, for emergency needs such as savings, health insurance, and life insurance. And fourth, for wise investment and storage program for the future. May I comment on 2 of these elements? Nothing seems so certain as the unexpected in our lives. With rising medical costs, health insurance is the only way most families can meet serious accident, illness, or maternity costs, particularly those for premature births. Life insurance provides income continuation when the provider prematurely dies. Every family should make provision for proper health and life insurance.
Okay, so there's going to be those immediate costs and there's going to be the continual costs that we have in the event of death. And so making sure that we have that income continuation through life insurance can be a huge asset that'll help balance the equation to help the family take care of the expenses, right? And then Marvin J. Ashton most recently published in 2007, appropriately involve yourself in an insurance program. It is most important to have sufficient medical and adequate life insurance. Okay, we're going to get a little technical here, and this is the academic part of our discussion today, talking about some definitions. So the economic value of a human life, can I have you read that?
Yeah.
It's real loud there.
It's the monetary amount created by an individual's current and future earnings or services rendered for dependents or organizations.
All right, so a lot of jargon in there, and let's talk about how that applies to some specific different individuals. Breadwinner of a family, you'd mentioned that before, right? Tell us about that.
So if they're making all of the income.
Okay, they're bringing in the income, they're covering the expenses, and we want to make sure that income's protected, right? What about a stay-at-home parent of a family? Yeah.
With that one, you got to think about like childcare, and then like funeral expenses.
Yeah. So childcare, funeral expenses, and I remember one year there was a study done by MSN, and it talked about all of the duties of a stay-at-home parent, from childcare to cook to maid to taxi driver to therapist to all of these other things, and it equated out to like $120,000 a year to be able to replace what that was covering. And anyway, I
had 2 grandkids this weekend, and my productivity got cut by 90%.
It's a lot, yeah. I remember my wife, the first year she went to girls' camp, and I was trying to balance things at home with the kids, and while I was at home, I was thinking about work, and then while I was at work, I was thinking about the kids and making sure they're okay and everything, and my wife got back, and we doubled our life insurance. So it's critical that, I mean, you don't realize how, I didn't realize how much financial value my wife adds to our family until kind of going through those times and trying to juggle everything. And it's tough. It's very difficult. So what about a key employee of a business? Any business owners in here? Okay, well, tell me your thoughts. So you've got a business owner, they've got one key employee that maybe drives most of the sales. Why would they care about having life insurance for that key person? Yeah.
So I was a partner with a company before, and I owned equity in the firm, and they actually had documents that in case I passed away, that the equity wouldn't go to my spouse, it would go back to the company, and they had ways that they could buy that equity back to make sure that it stayed within the company.
Yeah, to have a buy-sell arrangement, right? So having a buy-sell arrangement or being able to cover, I mean, the company may have a lot of fixed expenses, and if you lose the person who's driving most of the revenue, that can be very difficult to keep the company going, at least initially, right? We may want to have something that can help cover things in the short run, or we may need to be buying a partner out of a business in that respect. So, which is that next one there. What about a single retired owner of a large estate? Why would life insurance matter for them? What economic value do they possess? Yeah.
Is that the transfer of wealth to any heirs that they might have?
Yeah, so there's potentially some estate taxes on that, right? And so right now the exclusion is, I think, $5.49 million per person. And so it doesn't affect a lot of people, but if you have a $20 million estate, say most of that's in business valuation or real estate or something, and you pass away, well, the IRS is going to want a certain portion above that exclusion amount. So let's say 5.5 of that is gone, then they've got about $14.5 million that's subject to an estate tax at 40%, and that money is due, someone do the math real quick, roughly 15 million, 40%. I don't know what that is. Should we call it 6 million, 6 million-ish, right? 6 million due to the IRS within 9 months of the person's death. That's a lot of money to come up with. Do we sell half the business? Do we sell off a bunch of real estate? What if it's not an opportune time to sell the business, right? So that can be another reason for having some economic value and why people use life insurance in a business setting there. And we talked about this a little bit earlier, right? How does economic value change over time? Is your economic value greater now or greater later? What do you guys think? There's not necessarily a clear answer on this, right? So if we take a look at it right now, you're like, I'm not earning any money, so the economic value doesn't seem very high, but your income potential from where you are right now, your income potential's never going to be greater than it is right now, right? Even though you're not earning a lot. Later on down the road, you may have some additional earned income, and it may feel like your economic value is much higher because you're providing a lot more. And again, as that time goes on, as you have a how many people are married in here? Anybody have kids? Okay, so these things these economic value factors start mattering more when you get married, when you have kids, when you buy a house, when you increase your lifestyle, when you get a new job, and then you get a new car, and then you buy a different house, and all of these different things change, and your economic value becomes more important, and people relying on your economic value becomes more important. But then on the alternate side, as you get nearer to retirement, and again, your economic value is not in your income, but more in assets that you could leave, then your economic value actually decreases as you get older and through some of those retirement years. All right, we're going to come back to some statistical pieces here. So I'm going to read through this pretty quickly. Because the timing of death benefits can be difficult to predict, insurance companies are used to provide benefits when needed using a concept called risk pooling. Okay, so risk pooling is really contributions made by members of a group with similar risk to offset the cost of one or more members of the group. So let's say, for example, we have 30 people in this room, and you guys all band together and say, all right, if anyone in this group dies, we're going to cover the funeral costs and we're going to pay $15,000 for that, right? And so everybody pitches in some money to be able to, take care of that loss if that occurs, right? That's just a real simple example of what that looks like. So here's a more detailed example of life insurance. According to the 2007 period table for the Social Security area population of a 30-year-old male has a 0.1428 chance of dying. In other words, out of 1 million 30-year-old males, probability is that 1,428 would die this year. Females, less. So, if each had an economic value of 2 million, then 2,856,000,000 of death benefits would be needed to replace the economic value, requiring a contribution of $2,856, ignoring any cost of operations, in that year from each person to fund the risk pool. So life insurance companies create even more narrow risk pools, including but not limited to the following factors. So current and previous health conditions, family history of health conditions, tobacco or other drug usage, and hobbies or other avocations. In addition to these factors, premiums are also determined by policy type and duration, operational expenses, commissions, dividends, and even investment income. So, for example, I'm a reasonably healthy young male. I'm not going to be put in the same classification as someone who may be my same age and maybe my same situation, but has been diagnosed with diabetes or cancer, right? They're going to be in a different risk pool than I would be in. And so all of these different factors can come into play. So someone who's a skydive instructor, for example, is going to be in a different risk pool than I am. So, and so this average figure right here that we're talking about can be dumbed down, and insurance companies look at it and say, okay, well, this person, we're not going to take on that risk. They're not healthy enough, or they don't have they're not safe with their hobbies, and so we're not going to choose to insure them, and so some of those costs can be brought down. A lot of people ask too, how are death benefits paid out? And they can be paid out in as fast as a lump sum or as slow as a guaranteed lifetime income stream. So it really depends, and there can be a mixture of both of those as well. Yes?
So how would that look for tax consequences for a spouse?
Yeah, so from a tax standpoint, life insurance proceeds are income tax-free and estate tax-free if it's going to the spouse. And so that would all be brought into the estate or to the spouse's name as basis, right? So let's say there's $1 million of coverage, the spouse receives $1 million of coverage, and that's her money. There's no tax consequences on that. Now, assuming they invest that money, then the proceeds would be taxable, whether it's capital gains or dividend or interest income. Any other questions you guys have? Okay. I like this quote because, I don't know, rules of thumb they're interesting. I mean, they have a general purpose, but I think too often we live by rules of thumb or we take them as truth. So can I have someone read this aloud for us? Yeah, go ahead. In the white shirt.
Such as buying coverage equal to 8 to 10 times your annual income are inadequate shortcuts. Online calculators are apt to tell you to raise your coverage by 1 million, even if you already have insurance. The truth is that life insurance is a personal affair. Two couples may earn equal salaries, but it's silly to say that someone with 4 young children should have the same coverage as empty nesters with no mortgage and a substantial retirement fund.
Okay. So I love that, right? I mean, it's silly to think that two people in very different situations are going to need the same coverage based on maybe just an income factor. And so oftentimes when clients are coming in, they're talking to us and they have life insurance in place or they're wanting life insurance, they come up with this number, and oftentimes I'll ask them how they've come up with that number. And sometimes it's this detailed calculation, but most of the time it just sounded good, or it's what their buddy had, or something like that. I mean, much less sophisticated. So when we're looking at this and trying to figure out how much coverage do we really want or how much coverage do we really need, there's a lot of factors that can go into it. And so you guys have, as part of teaching tool 29, 7 or 8 different ways that
My wife's way.
7 or 8 different ways that factor in how much life insurance coverage you can come up with. And I think your wife's way was she doesn't want to touch the principal, but she just wants to peel the earnings off of it so that that number doesn't decline, and she feels like she would run out of money at some point, right? I mean, it's a scary feeling when the assets are depleting. So, and so there's a lot of different ways. Usually as we take a look at it, we'll talk with our clients about several different things. We'll talk about any mortgage or other debt expenses, funeral costs. Note that student loans, official student loans, are forgiven at death. So that's not something you need to factor into your equation.
Don't use that as part of your debt reduction strategy.
Future expenses for maybe a spouse or for kids, for education, missions, weddings, and then ongoing expenses. How much is needed to be comfortable, and for how long? How long do we want this money to last? Oftentimes, I'll hear people initially as they answer that question, someone in my situation that, I've got 3 kids, ages 12, 10, and 8, and my wife who stays at home with them and raises them, gets them to all the different places they want to be. Oftentimes people will say with a kind of a gut reaction, oh, my kids they're getting older, maybe another 10 years they'll be out of the house or be able to take care of themselves, and that'll be fine. And my question, I guess, to that is thinking of my wife, and she's educated, she has her degree, and she's a smart girl and could do a lot of things, but I don't know from a job standpoint how well she could walk into the workplace and get a salary that's not only going to allow her to provide for herself after being out of the workforce for 20 years and create enough retirement income that she could reasonably retire in her 60s. I don't know how she could do that within that short period of time. And so again, trying to just understand, really think through these situations of what would life be like if, right? And it's not fun situations to think about, right? We don't want to spend too much time on it. But I think someone talked about earlier, financial security is we want to make sure that we're thinking about now, we're thinking about the future, and if we can really spend some time, a few minutes, thinking about what those situations might look like and what we would want our families to be like in that financial situation, from a financial standpoint, and then take care of it, then we don't have to worry about it anymore, and we can go on and enjoy life. So, all right, different types of life insurance. So I think the best analogy for this is in owning a home versus leasing a home or a place to live. Life insurance has a lot of similarities that we can draw on there, but there are some key differences that I want to talk about as well. So when you buy a home, it's a little bit more permanent, right? Not that you can't move, but you're around for longer. It can be more expensive per month up front. There's some equity that you build over time in the home. You have more control. At some point, your payments will stop, and there's some tax benefits with the interest there. When you lease a place, it's usually more temporary. Sometimes it's less expensive per month. There's no equity build up.
You said sometimes it's less expensive. It's almost the term life insurance is generally about 1/10.
Oh, sorry, I'm talking about leasing
okay, sorry.
a house.
Yes. My red flags went up. I apologize.
Yeah, no, and life insurance always less. Well, I shouldn't say always actually, but we'll talk about that in a second.
Okay, sorry about
There's no equity, when you move into a place and you pay the lease payments for a couple years. You don't go back to the landlord and be like, how much equity did you make? Can I have that back? Right? There's less control. Payments will continue as long as you're living there, and there's no really tax benefits. So if we think about that from a housing standpoint, and let's translate that over into life insurance a little bit. So you can own insurance or you can lease insurance. When you own insurance, it's called permanent insurance. When you lease it, it's term insurance. It lasts for a certain term of years. The cost of permanent insurance is much more expensive. So when a home situation, it may be 10 to 20% more expensive. In a life insurance situation, it's often 10 to 20 times more expensive than term. So there's a big difference, right? The insurance company is saying you can have a policy where probability says you're not ever going to, or we're not ever going to pay out this death claim, to you're going to have this life insurance policy that you're going to own, and we'll pay out this claim at some point. We just don't know when, right? So it's a very different type of contract for an insurance company, and the expenses have to go along with that. There's some equity that can build up in life insurance. We call it cash value. There's a lot more control. Payments you can stop at some point and still keep the life insurance contract going. And there's some tax benefits. So any growth inside of a life insurance policy grows tax deferred. On the term insurance side, like we said, it's temporary. It's a lot less expensive per month. There's no cash value buildup. We have a little bit less control. There's not as many features. And then as long as we want to have that term insurance, we have to pay for it. So the payments, continue. There's not the tax deferred growth benefits, but the death benefits are tax free on both.
And you can make it. You can do a 10-year policy or a 20-year policy or a 30-year policy. So renewable term.
Yeah. There's a lot of different options for
in both sides.
For term. Yeah, a lot of different options for permanent as well. We'll talk about those. The one caveat that he was talking about, where I said, well, let me retract there. When you buy permanent insurance at a young age, then it can be less expensive than term insurance at an old age, if that makes sense, from a premium standpoint, right? And that would be the only really difference, or the only time where term insurance would be more expensive because of health or age factors. So, which type is better? We get this question all the time. And it really comes down to a person's situation and their goals for what it is that they're wanting to accomplish. So the goal is to have financial security, not just having life insurance, right? Oftentimes, as we're getting into conversations with clients about their overall financial security, we'll get to the life insurance section and we'll start talking about it. And a lot of times I'll hear, oh, I have life insurance already. And I say, great, tell me about it. And sometimes they don't even know what it is or how long it lasts, or it's through their employer. And like Bryan mentioned earlier, a policy through an employer isn't necessarily something that they can take with them, or if they were to become disabled, and then, because that happened to a client of ours as well. They became disabled, and then they eventually passed away, but they weren't an employee by the time they passed away because they were disabled. So they didn't have that life insurance coverage. So making sure that you have a life insurance policy that's going to last for as long as you need it, and going to provide the benefits, and that you can take it with you, that's going to provide a lot more financial security rather than just saying, oh, check the box, $50,000 of employer provided life insurance, and we're good. The goal, and this is huge, you guys. So in a life insurance contract, it's life insurance. We have to think of the death benefits as the first goal. Again, like Bryan said earlier, insurance is never your best investment. Investments are never your best insurance, and we have to understand how those two play together. There are other benefits that can have that permanent life insurance can have, and we'll talk about those in a minute, and they can be good, but they can't be the primary benefit that's driving all of this, because it's just there are more costs that are built in than an investment, and we want to understand again how those play together. So the situation, duration, and ability to pay premiums. Again, as Bryan referenced earlier, there's billions of dollars that are lost, essentially surrendered to insurance companies by people who get into a product that they don't quite understand, and a year or two later, they get out of it. And it's sad, it's unfortunate that they're getting into this, because a lot of that money, cash value takes time to build up. You guys have all seen, again, coming back to the home analogy, amortization schedule on a mortgage, right? That first year, how much goes to interest, how much goes to principal, right? I mean, it depends, but a lot of it goes to interest. And then it kind of slides down depending on where you go. Life insurance is kind of like the same thing, where the first year you put a lot of premiums into it, and there's really very, very little cash value growth. And then that changes over time. So if you think of a 10-year amortization schedule, and you think of a 10-year life insurance premiums of what's going to cost and what's going to cash value, that's kind of a similar analogy. And then after that 10 years, the cash value in the life insurance, typically whatever you're putting into it, it's growing by that and more. So let's talk about any questions that you guys have. We're going to dig into some term and permanent insurance a little bit more, but yeah, go ahead.
This might be the wrong time to ask this question,
Okay.
But I mean, you talk about getting certain things from an employer, certain types of insurance from an employer, and certain types not from your employer, such as life insurance. Which ones would you say are appropriate to get through an employer, and which ones are not?
Yeah. So anything your employer is going to give you, you take and say thank you, right? So sometimes employers will offer what we call a supplemental term insurance plan that you can get for you or for your spouse. In my opinion, and rates are usually generally pretty good. They're sometimes better than what you can get in the open marketplace. They're sometimes worse. So you want to understand what that looks like. In today's world, too, of how often people are staying at their jobs, it's not like we work for the same company for decades. So I've been with the company I'm with for 13 years next month. And I'll probably stay there for the rest of my life, but that's an anomaly. I understand that. And so oftentimes with life insurance, I would recommend getting it and looking at it outside. Disability insurance, sometimes you can opt out of their plan, sometimes you can't. Sometimes the group has a plan. Individual plans are usually stronger, but they're usually a lot more expensive as well. And so, again, something to be evaluated. Health insurance is something, again, oftentimes employers are providing that. With the current marketplace for health insurance, anybody can get qualified for health insurance. So whether you have it through your employer or whether you leave your employer and then go get it in the open market, whether you're healthy or not, you can get it. So that one's a little bit more flexible, I think. Yeah. All right, different type. Did I see another hand? No. Okay. Different types of insurance. So we have level term insurance and we have annually renewable term insurance. And so I think graphically is probably the best way to look at this. So here is for $1 million of coverage. Oh, we have a laser that doesn't work real well. So the blue line is $1 million of coverage, 20 years of level premiums. Okay. The yellow line is an annually renewable policy that goes until age 80, but gets a little bit more expensive every year. And so again, which of these is better? Well, it depends on how long you're going to keep the coverage, right? If you're going to keep the coverage for 10 years, well, then the annually renewable policy is going to be better. If you're going to keep it for 20 years, well, then the level premium might be better looking at those things. And so it really just depends on where we're at on things. So personally, what I recommend for young people is an annually renewable term policy that you can hold on to. For people who are in their 40s or 50s, I recommend having, or 60s even, I recommend having a level term policy because we're leveling out those premiums as time goes on. And typically, situations aren't changing as much in your 40s and 50s and 60s. And if our term coverage expires when we're in our 60s, we're okay. If we lock into a 20-year term plan when we're 30 and our coverage ends at 50, that may be a lot sooner than we want that coverage to be gone. And we may have to we would have to come back in for underwriting, and people can choose to apply at any time. Who gets to choose whether they're approved or not? The insurance company does, right? And so that premium can jump from here to here if they're at the best rate category. If they're in a good category, it's here, not so good, or a little bit bad is that red line up there, right? So that's, or you might not be able to get covered at all. And that is the difficult part about insurance is we never really know. Now, most people are able to get coverage at decent rates. But there are many, many people out there as well who would like to have more coverage, but they can't, or it's become so unaffordable that it's unrealistic for them to be able to have that insurance. And so, like we talked about before, any sort of those medical issues can come into play, occupational or hobbies issues can come into play as well in bringing this cost up. So, yeah.
Are insurance companies like auto companies, that different companies price risk differently? So you probably should check around. If you can't get it in one place, check around because you might be able to get it.
Yeah.
You might be priced cheaper in another place as well.
Yeah. So from a cost standpoint and from a medical standpoint, both. We have a client right now that we're looking at several different carriers because she had a transient ischemic attack a couple years ago. And so she's been declined by 2 carriers so far, but there are other carriers that may look at that a little bit differently. We have some carriers that aren't as concerned about weight issues or cholesterol issues. We have other carriers that aren't as concerned about using marijuana, and some carriers really are. And so it really just depends on what the carrier looks like. And yeah, the carriers are updating their pricing all the time, and as people are living longer, term insurance rates are decreasing, and so it's good to kind of keep an eye out and take a look at what's going on in the marketplace. So I'm going to skip this because we talked about this already. We talked about this a little bit earlier. You can have a 10-year level, a 20-year level, a 30-year level. There's a 15-year level that we're issuing right now, and there are some companies that will even say, pick your years, pick your number of years, how much you want, how long you want this, and we'll give you a quote on what that looks like. Yeah.
So each of these types of terms, this applies for both the permanent as well as the.
So this is just term insurance here. We're going to get to permanent insurance in a minute. Yeah. So the 10-year term obviously is a lot cheaper than a 20 or a 30-year term, right? The annual renewable just kind of goes along. As you get older, your chances of dying increase, and so it kind of increases along with that. Generally starts out lower than a level term policy, and then it ends up higher at some point. And so again, just trying to understand where things go. Anybody own a home in here? Yeah. So when you bought your home or you refinance, you start getting all these things in the mail saying, we'll cover your mortgage if you pass away, and check these boxes, and send in this much money, right? Yeah, Brian.
No, I was going to say I own a home.
Oh, okay. And accidental death and dismemberment. This is an important one to kind of understand. People sometimes think this is life insurance, which it is, but it's only under certain situations will it pay out. And so we have to understand what that looks like. And again, I remember talking to clients, like, oh yeah, we have $1 million of life insurance. We started looking into it, and like, oh, that's accidental death and dismemberment. So if you die from cancer, then it doesn't pay out anything. And they're like, oh, well, we should probably look at something else then. So there are some different riders, which is really just a policy add-on that creates a unique benefit for an additional cost. You can convert it from term to permanent. There's a waiver of premium rider, so that if you were to become disabled and you're starting to look at what bills to take off the table, unfortunately, life insurance is one of those ones that goes maybe before food, and so having a waiver of premium can be a good rider. There's again an accidental death and dismemberment rider. It's usually really low cost, so you can just weigh the cost-benefit analysis. There can be an additional purchase benefit, an amount of coverage that you can purchase in the future without any medical underwriting. Cost of living adjustment, and child benefits as well. So sometimes those can be really cheap. You can check a box. Yeah, Brian, why don't you tell your story?
For $2.17 a month, all my children have, like a $20,000.
Yeah.
Thing like that. So just watch your benefits. It's really important.
Yeah, it's
also spousal as well.
Spousal riders as well. Yeah, that's another one I don't have on here. But so those can be, check a box and adds a couple bucks, and it can be some good coverage. And when you have as many kids as Brian does, you're really getting a good deal. Yeah.
So you recommend for children just adding them on as a rider like this?
You can. So I have permanent policies on my kids. They each have $100,000 of coverage with this right here, additional purchase benefit. So that allows them to pick up $1,050,000 of coverage in the future if, for whatever reason, they're not able to from a health standpoint, or my son becomes a skydive instructor or something. They're able to pick that up, guaranteed best rates at the time. So
is there a way to also get a cash value plan for them that they can then roll over when they become of age?
Mm-hmm. Yeah, so that's what I have on my kids.
Oh, okay.
And he has the benefit is he doesn't have to pay the expenses on it.
Oh, yeah.
Well, I do. My son was saying I pay all the expenses, but I get the commissions for it, so it does help out a little bit. I said a little bit. So, anyway.
Be careful with stuff. I mean, Tyler and I have a difference of opinion. Other than my $2.17 a month, that's all I pay for all of my kids together. So you realize there's different goals.
Absolutely.
And just because I say it doesn't mean it's right. It just means that I have an opinion. We both have different opinions.
Yeah. Same for me. So I said that's what I have on my kids, but it's not necessarily what I'm recommending for everybody either, because again, it's a little pricey. So let's talk about some whole life and universal life and some other variations for a few minutes here. So this is coming to the permanent insurance standpoint. And permanent insurance is essentially you pay in a premium to it each year. Again, usually a lot more expensive than term insurance, 10 to 20 times more expensive. And at some point, the company knows they're going to pay you a death benefit. And also, because of that, because they know they're on the hook, the company's on the hook already, they allow you to take a certain amount of that death benefit while you're living. And that's what the cash value is. So you can take that money out, and the older you get, the closer you are to getting to their assumed age of your death. And so the closer you get to that age, the more and more money you can take out, because the closer the company is to paying out that claim, right? So in the first few years, you might only be able to take out 5% of it, of the total death benefit, right? Let's say, and then in the last few years, you might be able to take all of it out, or in the final year, or you might be able to take 90% of it out. So it's just a way of getting access to that death benefit prior to you passing away. A lot of people will like it because it does have those tax benefits. It does have the growth that's in there, which can be a fixed rate of growth, or it can be a variable rate of growth, which we'll talk about in a minute. And it also provides, in retirement, can provide, I should say, kind of a safe place for dollars that you can get access to. And so a lot of times this will fit in when, from an investment standpoint, you've kind of maxed out your Roth IRAs if you can qualify for them. You're maxing out an employer-sponsored retirement plan, and you're looking for additional diversification and additional places to be putting dollars that are getting some tax deferral, right? So wanting some maybe a safer place, or in my case, for example, my 401k and my IRAs are 100% equities. So I've no fixed income in there, because I have cash value in a whole life plan that acts as kind of my fixed income piece. And so there's different ways to balance that out. And again, we have to understand how it all fits in together. So, but I also understand, again, my whole life is primarily life insurance. Permanent life insurance is going to be around for as long as we need it, or as long as we want it. And then it has that secondary benefit of the cash value there. So whole life is built on guarantees. Universal life is built on assumptions. So as Brian mentioned, if the company's wrong on their assumptions, a perfect example of this is in the in the 80s, universal life kind of became really popular. Interest rates were really high, and the assumed interest rates that the companies were using on their illustrations were getting 12%. And then interest rates started dropping, and now they're, those same plans, instead of getting 12%, are getting 4%. And because the whole thing was built on assumptions, they're assuming a certain amount of premium based on a 12% return. And when you're not getting a 12% return, but you're getting a 4% return, you have to put a lot more money in that contract to keep up with the internal insurance costs. And so we've seen a lot of policies really kind of blowing up and not working out, right? I mean, you pay this $100 a month for all these years, for 20 years, and then suddenly you get a notice from the company saying you have to pay $600 a month if you want to keep your insurance coverage, because that's where the cost of insurance has gone, and that's where your cash value has all been depleted. So again, understanding annual reviews, make sure that you understand what kind of contract that you have. And there's a lot of variations of these. There's a variable universal life. Indexed universal life is kind of the popular one.
It's the most complained about.
Yeah, I should say, yeah. It's the latest and greatest, right? The flavor of the month. Thank you. But it is, and there's a ton of complaints. People don't understand it, and not saying that there's not a place for it, but it's a very complex and a very squirrely product.
It's a product where the insurance company, it matches. They say, well, you give exposure to the like an index such as the S&P 500, of course, without dividends too. Yes. And then what they do is they say, oh, but you've got a cap of 14%, but then they can continue to drop that cap without doing so.
We've seen those caps drop, and one I saw, it dropped to 10, and there was a spread of 5, and so if the market got 10, then his maximum amount he could get was 5%. Right. And it was like,
and
this thing.
The books you read. I've got a book here that says, okay, it compares this index universal life policy at a 14%. It says, well, that's really good, but it puts 0% for expenses.
Yeah.
And it doesn't tell them that they can cut the caps on it too.
Right. Right.
And so just be really careful.
There's all sorts of things. There's it's like anybody who writes a book or puts a podcast out there or has a commercial or something, we automatically give credibility to that when we really shouldn't. It's just too easy to produce all that stuff these days. Yeah.
Are these fluctuations of rate based more upon the time of the client, how long they've been a client, or is it like all clients pay if the rate's being dropped, the rate's being dropped?
Yeah, so it's not generally per client, but more of the time period. As interest rates have declined, so have dividend rates or crediting rates inside of these types of policies.
So no kind of promo rate, you're going to get 12% starting out.
Well, there's that too.
Okay.
Yeah, that can be, especially with annuities, that's more kind of like, you see these titles of some of these annuities like Bonus Index Master Plus, and it's like, what is this? So and it's like this really great rate for the first year, and then after that, not so much. Anyway.
Especially about like different insurance companies, because is it a potential risk? Because you're like, I'm going to hold on to this for the rest of my life. Well, that's a long time from now.
Yeah.
And like have we seen in the past like some life insurance companies, just insurance companies go down and go under, and then people get screwed.
Yeah.
What should we be aware of that?
So it's really important, I think, to talk about that. In my experience and from what I've seen, I don't know that I've ever seen someone who had a policy and then because of something the company did, they didn't have a policy the next day. What I have seen is companies that I won't mention, but that have been deemed too big to fail, and they were bailed out by the government, and people who had life insurance with that particular company were did not feel financially secure, and there was actually a industry-wide restriction that you could not replace that company's product with a different company because of fear of financial security. So, and that caused a lot of angst in a lot of people at that time trying to figure out, okay, well, is this company going to be around? What's going to happen with my policy? But then there are a lot of companies that kind of get eaten up and conglomerated, and then you're like dialing this 1-800 no service number, and you just don't know. It can be frustrating sometimes, but generally the policies are sold and bought by somebody else, and they're usually around. So, yeah.
I just have a general question. Well, I have two.
Yeah.
The first one is, so you said it would be like state and federal tax-free to a spouse. Is that also available, like, say your spouse died, would that also be available to your kids? Like,
Yeah.
state and federal tax-free? And then what would happen in a divorce case?
So and let me just maybe clarify what I said there. So completely income tax-free, estate tax-free. So not state, not federal, but estate tax-free, wherein, again, there can be some estate taxes on estates that are over that 5.49 million. And going from a spouse, then there's no estate tax there. Going to the next generation, there could be an estate tax if the total value of the estate is greater than that limit. So.
Just my second question, so.
But sorry, still state and federal tax-free to all beneficiaries.
Okay, and then say like if you were divorced or whatever, and would that life insurance benefit go to your immediate spouse and kids, or would it also be shared with previous spouse and kids?
So life insurance passes. Have you guys all had business law? County 241, I think is what it was when I was here. Life insurance passes by contract law rather than probate law. So there's specific beneficiary designations, same for IRAs, there's specific designations as to who that's going to go to. So if you get divorced, then you need to specify in there by name who you want it to go to. There's been certainly times where an ex-spouse got the proceeds and not the current spouse. You could imagine how that went, especially when expectations were not that. And so you can name an ex-spouse, you can name a current spouse, you can name it split between an ex-spouse and a current spouse and kids, so that it really will go by what the beneficiary contract, or what the beneficiaries in the contract say. Any other questions you guys have? Okay, so here's a lot more information you guys can read through on your own. Again, understand the steps to buying. Here are some different ratings for financial strength that you talked about. These are some different ones. Aggregate consumer complaint reports you can look up as well. There's some resources. And I'm going to end on this, just first presidency message. This is the last financial thing that I have heard over the pulpit. I think this was read over the pulpit. This is a while ago. But consideration should also be given to investing wisely with responsible and established financial institutions. We are also concerned that there are those who use relationships with trust to promote risky or even fraudulent investment and business schemes. But not in Utah, right? Right. Okay, so while all investments may carry an element of risk, that risk can be managed by following sound and proven financial principles. First, avoid unnecessary debt, especially consumer debt. Second, before investing, seek advice from a qualified and licensed financial advisor. And third, be wise. And so, turn it back to you. Okay, takeaways that you guys have.
One other thing too is here is your previous items. If you want to come by and grab them, I'll put them right here.
Yeah.
I think a big one for me is like it just depends on like your goals and like where you are in life and what you want to accomplish. Absolutely. I think like probably the farther you get in life, like the more money you have, like your retirement fund kind of becomes your life insurance.
Absolutely. Yeah. Or it should. Yeah. If you follow all the principles in this class, then it should. We see a lot of cases that it doesn't. That's not the case. And this case that I talked about earlier with this gal who's not able to, who's been declined by 2 companies. She's 70 years old, still working 2 jobs. Right, husband's still working. They've been very, very nice to their children, and more than I've counseled them to be.
I joke I'm spending my kids' inheritance. I want them to be sad when I die.
Which is good. So yeah, some kids get it too early, and then the parents are in a tough situation. So yeah.
So like understanding the insurance products is like essential for like finding. I think along with that is like trusting somebody to explain the complexities of that insurance product as well.
Yeah.
So that that's
Right. Trust and verify. Right. I mean, even Don't assume that just because someone's licensed that they know what they're talking about. And so. We can get a whole into academics versus the business world at a different time. But yeah, understand. So having trust in somebody and then understanding what it is and really making sure your questions are answered. Important. Other questions you guys have or thoughts, comments, takeaways?
David, I told you I was going to pick on you today. What's your takeaway?
I thought it was really interesting. I didn't know that a lot of term insurance policies are not renewable. So like you were saying, if it ends when you're 50 or something and you can't renew it and you die after that, then there'd be no benefit for you. Yeah. So just understand when to use term and permanent life insurances and what if it's renewable or not.
Mm-hmm. So here's my takeaways just for today. Number 1, understand yourself, your goals, and your needs. That way you can make insurance truly work for you. 2, understand each of the benefits and costs of each type of insurance. What do we want to do? We want to use insurance to our best advantage. And number 3, insurance is helpful, but the only true insurance is through Jesus Christ. We must see in Him and Him alone the captain of the world. Thanks, everyone. We will see you on Sunday.